Hi everyone, and welcome to ACCA P4. My name is Fred Aikon, your ACCA P4 lecturer. So this is P4 live session 1. Can I get somebody to confirm that you can hear me clearly? Brilliant. Okay, so today we're going to look at Session 1 of our P4. And Session 1, we need to look at Chapter 1, which is in relation to issues in corporate governance, and that is going to be self-studying. And we're also going to look at Advanced Investment Appraisal 1 from Chapter 2. So that is where I am going to start the Session 1. Chapter 1 is going to be a self-study, and chapter number 2 is where we are going to start. So we pick our lecture notes, and then we start from chapter number 2, Advanced Investment Appraisal, Session 1. So if we go to our lecture notes, chapter 2, we will see that advanced investment appraisals, and we're going to pick from there. So make sure you've got your lecture notes in front of you. Okay, right. When we did F9, we did investment appraisals, or the elementary bit of F9 told us that the financial manager is supposed to make 3 basic decisions. And the first decision that the financial manager is supposed to make is what is called the investment decision. And what do we mean by that investment decision? Investment decision is for the financial manager to identify which profitable investment the company should be undertaking. The question is, how can that financial manager identify that profitable investment? That investment is supposed to be appraised. So investment appraisal is basically the process the financial manager has to go through in order to ascertain as to whether undertaking the project will lead to maximization of shareholders' wealth, which is the assumed financial objective in financial management. At F9 level, we were supposed to learn 2 broad techniques of investment appraisal techniques in here, which were the discounted approaches and the non-discounted approaches. The non-discounted approaches were the payback period and the accounting rate of return. That is for F9. For our P4, our syllabus specifically states that we would have to learn the discounting techniques of investment appraisals. What is basically the discounting techniques of investment appraisals? The discounting techniques are those techniques of appraising investment which takes into consideration the time value of money and the total profitability of the investment. Okay, so the discounting techniques will take into consideration the time value of money. And those techniques that we would have to be learning under our P4 syllabus should be the net present value, which most of us, we've met it before. Internal rate of return, we've also met before. Modified internal rate of return, most of us haven't seen. Discounted payback, we've met before. Duration, we haven't. Profitability index, we've met it before. And then adjusted present value, we haven't actually met it before. I mean, from F9 level. We're going to do all of them, whether you've seen it before or not, because we would have to emphasize on all of them. So your syllabus expects you that you will be able to use any of these techniques as a base of evaluating as to whether a project is supposed to be undertaken or not. So we're going to take them one after the other. We talk about them, we pick a question, and then we actually see how it works. So the first technique that we would have to learn will be the net present value. What is the net present value? The net present value measures the total profitability of the project after we've taken into consideration the time value of money. And as we know from basic level, NPV is simply calculated as the present value of the future cash flows minus the initial investment. The present value of the future cash flows minus the initial investment. Okay, minus the initial investment. I am going to slightly change this definition. The reason being that when we talk about initial investment means we are incurring the cash outflow for the investment in year zero. We are getting the cash flows initial in year zero. And that year zero means the project. When you are starting, you can just start it now. But in reality, what happens? In reality, it might take you about 2 or 3 years for you to construct the project before after you will start receiving inflows. So I'm going to change this slightly because in reality, project is not likely to be started now. For instance, if I have to put up this building, it won't take me now to finish it. It's going to take me about 2 or 3 years to finish the construction of the building. Then thereafter, return will be coming by way of rent. So you need to remember that when you have to calculate NPV, we are changing the definition slightly. NPV should be calculated as the present value of your return phase. Return phase cash flows minus the present value of investment phase. Investment phase cash flows. This is what we used to say present value of the future cash flows and then minus the initial investment. But as I just said, with the initial investment, we are trying to imply that, the project will start from year zero and the construction of the asset will just be completed now. But in reality, it might take you maybe 2 or 3 years. You have to find the present value of that investment phase and you find the present value of the return phase. When you find the difference, it should give you the NPV. If you are lucky enough and you go there and the investment phase is just in year zero, then you are putting your initial investment in there and then you calculate the normal NPV. Okay, so if NPV is calculated as the present value of the return phase cash flows and present value of the investment phase cash flows, then if you are asked to calculate NPV, what variables do you need to calculate that NPV? Whatever the question is, however big it is, you would have to make sure that you need only 3 variables to calculate NPV. The variables you need to calculate NPV should be the number of years the project should run, the relevant cash flows, and the appropriate discount factor. Okay, so anytime they ask you to calculate NPV, you are supposed to look for 3 variables. The first variable should be the number of years, the relevant cash flows, and the appropriate discount factor. If you look at your lecture note, we haven't said discount factor. We've said appropriate discount factor. That word appropriate is really, really important. At the appropriate time, I'm going to show you why we are using that word appropriate. Okay? Next, if NPV is the difference between the PV of the cash flows from the return phase minus that of the investment phase, then your NPV might give an answer which is either a positive or a negative or a 0. When the NPV is positive, then the project is profitable and as such we would have to accept it. If the NPV is negative, then of course it's a loss making and the project should be rejected. If the NPV is 0, then the project break even. So this is the background of the NPV. We're going to take a bigger question to calculate NPV. Now let's move on to internal rate of return. What is internal rate of return? Alternative name for internal rate of return is economic rate of return. Alternative name for internal rate of return is the economic rate of return. At F9 level, we were told that internal rate of return is the rate that will make the NPV equals to 0. Okay, I personally find it very difficult to understand that definition. The rate that will make the NPV equals to 0. If you explain it to somebody who is not from a financial background, he might not be able to understand the meaning of that internal rate of return is the rate that will make the NPV equals to 0. So if you would have to explain it to a layman, how will you explain that internal rate of return? Okay, when you would have to undertake the project, you have to finance it. And by financing the project, you would have to incur a cost of capital, because the person going to give you the money to finance the project is not giving it to you for free. That person is supposed to demand a return from you. And that return, you will see it as what? A cost. So the cost that you would have to pay to that person to raise the money at worst should let you break even, because you don't want the project to result into a loss. So the cost that you would have to incur in raising the money, the maximum you would have to incur should be the cost that will bring the NPV to be equal to 0. And we all said that when the NPV is equal to 0, the project will break even. So in simple terms, the internal rate of return is the maximum cost of capital. The company should be prepared to raise the capital in order to finance that particular project. So if my internal rate of return is, let's say, 10%, it means the NPV will be equal to 0 for me to break even. So when I go to the bank manager for a loan to finance the project, then the maximum return I have to pay to the bank manager, or in simple terms, the maximum interest I have to pay to the bank manager should be equal to 10%. So if I go to the bank manager and he says, okay, I am going to charge you a return of, let's say, 15%, automatically I know that if I take up that loan to come and finance the project, the NPV will simply be negative. And of course, I don't want to undertake a negative NPV project. But if I go there and he says, okay, I'll give you the loan, but I'll give it to you at a rate of 8%, then obviously I can take the loan, because I know that when the NPV is positive, it is good for me. And at 8%, the internal rate of return of 10% being the maximum, any rate below that internal rate of return, the NPV will be what? Positive. So in layman's point of view, that internal rate of return should be the maximum cost of capital. We should be prepared to raise the money to finance the project. We all know that to calculate internal rate of return, you need 2 NPVs, and they are corresponding rate. One NPV ideally being positive, another NPV ideally being negative. And then when you get the 2 NPVs at their rate, then you will calculate the internal rate of return by putting in the internal rate of return formula. The lower rate plus the NPV of the lower rate divided by NPV of that lower rate minus the NPV of the higher rate, all multiplied by the higher rate minus the lower rate. And this is the formula for calculating an internal rate of return. What is the decision rule and internal rate of return? The decision rule and internal rate of return is basically what I explained here. If the internal rate of return is the cost of capital, that will make the NPV equals 0. The maximum cost of capital, that will make the NPV equals 0. If the cost of me raising the money is less than that internal rate of return, that NPV will be positive, as we showed here. Therefore, you will only accept the project if that project's internal rate of return is greater than the cost of capital. So if that IRR is greater than the cost of you raising the money, then it means it is acceptable for you to undertake the project, because it will result into a positive NPV. Now let's move on to discounted payback period. At your basic financial management, you learned payback period, and payback period was the number of years the cash flows from the project will be able to recover the investment. And that was criticized on the basis that payback period does not consider the time value of money. Okay, because we are not discounting the cash flow, so it wasn't taken into consideration the time value of money. And as such, the discounted payback period was introduced. So discounted payback period is measuring the number of years the present value of the future cash flows will be able to recover the investment, will be able to recover that particular investment. So we're going to take figures to illustrate the three after we've gone through the basic principles. We all concluded that in order to calculate MPV, you need number of years, you need the relevant cash flows, and you need the appropriate discount factor. Number of years, every question is supposed to give it to you. But relevant cash flows, the examiner might obviously push you to calculate the net cash flows, which you need the application of relevant cash flows. So let's refresh our minds on what is relevant cash flows. Relevant cash flows are those cash flows that will influence the decision as to whether the project should be acceptable or not. And for that cash flow to be relevant, it should possess two broad characteristics. The first one is that the cash flow should relate to the future. The cash flow should relate to the future. So what is it telling you? It's telling you indirectly that if that cash flow has already been incurred, then it's gone. It's a past cost. And as such, that will not be relevant. So that cash flow should relate to the future, and that cash flows should be received or incurred as a direct attribute to that particular project. So that cash flow should be directly attributable to the project. It should be directly attributable to the project. Okay, it should be incurred or earned specifically because of that project. So in other words, here is that the cash flow should be specifically incurred. It should be specific to that particular project, and that will influence the decision as to whether the project should come in. So for that cash flow to be relevant, we say it should be incremental. Incremental means it's an additional cash flows you're going to get by you bringing the project. So when I bring the project, obviously, if I sell the product from the project, I should be able to get more sales in the future. And as such, it is incremental sales. It's relevant in me taking the decision. We also say that that cash flow should be avoidable. Avoidable cash flow. Sometimes some of you use variable costs. And the argument here is that if somebody say variable cost is relevant, there's no argument about that. Okay, because variable costs are additional costs. So variable costs associated with the project is obviously relevant. However, if you say variable cost is relevant, does it sound that fixed cost is irrelevant? Does it sound that fixed cost is irrelevant? That is the argument. Fixed cost, when we were talking about the characteristics here, we said that cash flow will be relevant if it is incurred specifically or is directly attributable to the project. Okay, so when you are talking about fixed costs, we've got two broad types of fixed costs. So for your fixed cost here, we have got what is called the specific fixed cost, and we've got what is called the general fixed costs. Okay, specific fixed costs are those fixed costs which are incurred as a direct consequence of you undertaking that particular activity. And once it's incurred as a direct consequence of you taking that activity, obviously it becomes what? A relevant cash flow. So specific fixed cost is relevant, but general fixed cost will not be incurred, will not be incurred as a direct consequence of you undertaking that particular project. And as a result of that, that general fixed cost become irrelevant. Okay, whether we would have to undertake the project or not, that general fixed cost will be undertaken. Will be incurred, and as a result of that, it becomes what? Irrelevant. So the advice is any cash flow you can avoid. If you decide not to undertake the project, that cash flow is relevant. Any cash flow that could be avoided if you decide not to undertake the project is a relevant cash flow. The last one is the opportunity cost, which is basically the benefit that you might forgo as a result of undertaking the project. As a result of undertaking this project, there might be benefits somewhere I will sacrifice. I'll have to include that benefit I'm sacrificing as part of costing that particular project. What are examples of irrelevant cash flows? Depreciation obviously is out of the equation because depreciation does not involve movement of cash, and as a result of that, it shouldn't be part of your cash flows. Apportioned fixed cost, this is what we were referring to as the general fixed cost. Okay, apportioned fixed cost or apportioned overheads or general overheads, they are irrelevant. They are irrelevant. Interest payment. Okay, interest payment. Interest payment is irrelevant. There's argument in here, so let me try and clear it for you. Okay, we all said that the relevant cash flow should be the cash flows that are incurred as a direct consequence of undertaking the project. If I have to finance that particular project and I go in for a loan, I would have to pay interest. So that interest is incurred as a direct consequence of that particular project. Why are we saying that that interest is irrelevant? That is where most people get confused. Okay, because that interest is incurred because we went in for a loan to finance this particular project. So that interest should have been part of the cash flows for deciding whether the project should be acceptable or not. I understand the argument, but the only thing most people forget about this bit, okay, I wouldn't say fixed cost is totally irrelevant. Fixed cost, general fixed cost is irrelevant. General fixed cost is irrelevant, but specific fixed cost is relevant. Assuming I have to, as we are doing the P4, I have been employed to teach the P4, and I'm on a fixed salary. My salary is fixed, but if you want to decide the overall cost of running P4, even though my salary is fixed, because the work is specific to P4, that's my salary being it fixed is a specific fixed cost, and as such, it is part of what the cash flows you would have to take into account in deciding whether the project should be undertaken or not. But if we are costing P4, we can't think of bringing something like the chief executive salary, because the chief executive salary obviously will be incurred whether we are doing the P4 or not. So that chief executive salary becomes straightforward a general fixed cost, which becomes irrelevant. So let's come back to the interest. Interest payment, as I was saying, people tend to develop argument on interest payment, which I don't blame them at all. Okay, interest payment is that we have raised money to finance the project for which there is interest to be paid. That interest is specific to that particular project, so it should have been relevant. Why are we saying it is what? Not relevant. It is not relevant because the interest that you will pay on the loan is a cost of capital to you. And that cost of capital to you is what you are using as the discount factor. So if you use the interest as a discount factor and you also use it as part of the cash flows, you have duplicated the interest element. So interest can only be included as part of the cost of capital, but not part as the cash flows. Okay, so watch out. So the absolute amount of the interest is out of the cash flows because the interest effect is gone to the discount factor. Okay, next, sunk cost. What is sunk cost? We said for the cash flow to be relevant, it should relate to the future. Okay, so sunk cost is alternative name for past cost. Okay, past cost. So sunk cost or past cost. Because the cost is already incurred, you cannot avoid it. So whether you decide to go ahead or not, it relates to the past. It has already been incurred, which is very similar to committed cost. Committed cost is a cost that has already been incurred, but it is yet to be paid on the future date. And that also confuses people. That because that cost had been incurred and it to be paid on a future date, they think, it's a future cost. It's not a future cost because the cost is already incurred. Once it's already incurred, whether you have paid it or not, you had already committed yourself, and straightforward, it becomes irrelevant. Notional cost is very close to opportunity cost. Notional cost is very close to opportunity cost. So if notional cost comes in, you have to be very careful in this case. What do we mean by notional cost? Notional cost is a benefit you will forgo or you thought you will forgo as a result of undertaking the project, but you wouldn't forgo it. Okay? Opportunity cost is a benefit you will forgo as long as you undertake the project. Let me give an example to illustrate. As we are doing the P4 in this room could also be rented out and we'll get rent of £1,000. Okay? As we are using the room to do the P4, we could have rented it for £1,000. Is there somebody standing outside there who is ready to rent the place if we are not doing the P4? This is what would differentiate between opportunity cost and notional cost, so be with me. If we have to do the P4 here, there should be £1,000 rent for this room. If we do the P4, it means we cannot rent the place. Okay? Is there anybody standing outside there that if we decide not to do the P4, that person is ready to come and rent the place and pay us that $1,000? If there's somebody standing there who is happy or readily available to rent the place, by doing the P4, we cannot rent it to him, so that $1,000 we will forfeit it. That becomes an opportunity cost. But if there is nobody outside there ready to come and rent the place, whether we do the P4 here or we don't do the P4 here, the place will not be rented out for us to get $1,000. It is in our head that when we rent this place, we could have got the $1,000. That becomes notional. So notional cost is not relevant because whether you do the project or you don't do the project, that benefit will not be forgone. And as a result of that, it becomes irrelevant. Now let's move on to the next. Working capital. Working capital, when you are doing investment, obviously, you don't need only fixed capital. You need fixed capital. At the same time, you need what? Working capital. Working capital is the capital you would have to run the business on day-to-day basis. Okay, so when I'm doing the project and I get my non-current asset, I'll also have to get what? Current asset and current liabilities, which is the working capital to run the business on what? Day-to-day. And by convention, as probably we saw in our F9, working capital that you would have to invest, you have to what? Recoup it back. Working capital that you would have to invest, you would have to get it back. All this, there's a question that we're going to use to reflect all of that. Okay, so now let's go to inflation and project appraisals. Inflation and project appraisals. We all know that inflation has got the effect of increasing cash flows. Inflation has got the effect of increasing prices. So when you read the question and there is inflation in the question, you would have to ask, how will inflation affect your revenue? How will inflation affect your costs? And how will inflation affect your cost of capital, which you are using as a discount factor? So where there is inflation in the question, this is how you would have to think and handle it within the question. Because inflation can affect my revenue. So ask the question, how do you want me to affect revenue and the inflation? Question will give you the instruction. How will that inflation affect the cost? How will that inflation affect my discount factor? Okay. We will definitely practice a question on that because this is how it flows. We have to explain before we take the question. We can't just take the question straight. So when there is inflation, you would have to think of the fact that inflation might affect your revenue, inflation might affect your discount factor, and it will affect your costs. Okay. However, there are certain terminologies we would have to refresh our minds on. We use the word money cash flows, or in other words, we would say nominal cash flows. When we say something is in money terms or is in nominal terms, then we are telling you that that cash flow or that item, we have already inflated it. So when I say this cash flow is nominal, it means that cash flow is after inflation. Same way, when I say cash flow or something is in real terms, it means it is before adjustment of inflation. You haven't actually inflated that. Okay. And when we were doing the variables for the calculation of MPV, we said we need relevant cash flows, we need the number of years, we need the appropriate discount factor. This is where the word appropriate is going to be explained first. So if my cash flows are nominal, if the cash flows are nominal or the cash flows are real, we all said if it is nominal, it means we have inflated the cash flows. If it is real, it means we haven't inflated the cash flows. The discount factor that we would have to use to discount the cash flows should be the appropriate. What do we mean by the appropriate? The appropriate here means you would have to compare like against like. So if my cash flows are in nominal terms, the appropriate discount factor I will need should be the discount factor which is consistent with the cash flows. And that appropriate discount factor should also be the nominal discount factor. You always have to remember that whatever cash flows that you get, it should be corresponding to the discount factor. You have to compare like against like. So if the cash flows are real, my discount factor should also be real. My discount factor should also be real. So that is the argument in here. However, sometimes the examiner gives a cash flow which is nominal and then gives you a real discount factor. What should you do? You would have to bring them to the same level. Therefore, I have to convert the real discount factor to the nominal. How will I be able to do that? We have to remember the Fisher equation. And according to the Fisher equation, 1 plus the nominal or money rate should be equals to 1 plus the real rate, 1 plus the inflation rate. So giving me the money rate, if I want the real rate, giving me the money rate and the inflation rate, I should be able to calculate that. In other words, given any two of them, you should be able to calculate the other. So that is what you would have to refresh your mind on. So example here is a company has a nominal cost of capital of 18% per annum. If the inflation is 6% each year, calculate the company's real cost of capital to the nearest 0.01%. Okay, so we're using this formula. So if we are using that formula, the cost of capital in terms of nominal is giving us 18%. So I'll say 1.18 here is equals to 1 plus R. The real rate is what I'm looking for. And inflation rate is giving us 6%. If you are looking for the R, you have to take these ones from there. So I'll say 1.18 divided by 1.06 minus 1 should give you your R. And then what will be the R? The R is the 11.32% given. So this is the primary school thing we are refreshing our mind. P4 is F9 plus other things. So if your F9 is good, you carry it on. If it's not, don't bother. We're still looking at all these. That's why I haven't brought a question straight. Okay, so let's go to the notes. So we are taking advantage to refresh our minds on the basic investment appraisal before we move up. Okay, let's take this simple question to illustrate. AP, a project requires an outlay of 1.5 million in year 0 and will repay cash flows in real terms, today's prices, as follows: year 1, 2, and 3. The company's money cost of capital is 50.5%. Appraise the project if inflation is estimated to remain at 5% per annum. Obviously, you are not going to get a question like this in P4, but we will see its application in a bigger question. Okay, that's why we are handling them one, so that when we see it in a bigger question, we'll be able to bring all those principles to bear. Okay, so they've given me cash flows in real terms. It means these cash flows here are not inflated. It means the cash flows there are not inflated because it's saying it is in real. If it is in real, they've given me money cost of capital. I cannot discount those cash flows using money because we said you have to compare the like against like. We need appropriate. Therefore, what can we do? Okay, there are two ways. I can either keep the cash flows in terms of real and discount it using the real discount factor, or I can also increase the cash flows by inflation and bring it to the nominal and discount it with the nominal discount factor. So it's one way or the other. But the only thing that you need to remember is that always your cash flow should be consistent with the discount factor. You cannot miss them. So if the cash flow is A, your discount factor should also be A. Simple. That is the word appropriate discount factor in there. Okay, so what we did here for you is we kept the cash flows at real. We kept the cash flows at real, and there's the need for us to convert the nominal discount factor of 15.5 from nominal to the real. So if you see, this is what we did, and then we converted it into that. If you want us to do it again, just as we did here, the same principle, we will say the nominal is 1.155 because it's 15.5%. Is equal to the real. We don't know the real, and the inflation rate is giving us 5%. So I will say 1.155 divided by 1.05 minus 1 should be the real, which is approximately the 10%. So we will discount using the 10%. And we all know that discount factor of 10%, you can read it from the table, the present value table, or if you want to calculate it, we calculate it at 1 divided by 1 plus n r raised the power n. Okay, 1 plus r raised the power n. This is how we calculate it. That's what we did here for you. So you can read the 10% from the table. If you multiply by the discount factor, this will be your MPV. Basic, this will be your MPV. The second method that we can use here is keeping the cash flows in nominal terms and then discounting it using the nominal discount factor. But look at something. The cash flows they gave to us, all of them were in today's terms, and they were subject to inflation of 5%. So the 670 should be inflated by 1.05. The 500, which is in year 2, remember, was referenced to year 0 because they said it is in today's terms. Therefore, you would have to multiply it by 1.05 raised the power 2. And then the 1,202 was also referenced in terms of today, so it should be 1.05 raised the power 3. When you get the nominal cash flows, you need to multiply by nominal discount factor, and you see that all of them will give you the same NPV. You see that all of them will give you the same NPV. Okay, so this is the general idea of inflation. Where there is inflation in the question, ask yourself, how will it affect your discount factor? How will it affect your cost and then revenue, which is basically the cash flows? The next thing we would have to think of and relevant cash flows is tax. When we undertake the project and the project results into a taxable profit, the company would have to pay extra tax. And we all said for there to be a relevant cash flows, that relevant cash flows should be an incremental or additional. Therefore, when we undertake this project and that project brings in an additional taxable profit, it will result us paying additional tax. And as such, we would have to factor that additional tax as part of we deciding whether the project should be acceptable or not. Same way, when there is tax in the question, normally there are three things you would have to do in relation to the tax. First, get your tax on your cash profit. What is your cash profit? Your cash profit is your sales minus expenses. And what do we mean by expenses here? We need relevant expenses. And those relevant expenses will be the variable cost and specific fixed cost. We've already said that. Okay, specific fixed cost. General fixed cost is irrelevant. It's not part of it. Okay, then the second thing you need to remember and tax is how to sort the tax savings on capital allowances. How to sort the tax savings on capital allowances. And then the last one is, because we are dealing with cash flows, we are interested in receipts and payment. When is the money expected to be received and when the money is expected to be paid? So you would have to respect the timing. Examiner might tell you the tax might be paid in in arrears or in relevant years. So if he says it's in arrears, then year one will be paid in year two. If it says in relevant years, year one will be paid in year one. So when you read the question and there is tax, you have to be organized and know how to handle it within the investment appraisal situation. Okay, that is how the note has been prepared for you. That when you see inflation, what are you supposed to do? If you see inflation, check how it will affect your revenue, check how it will affect your cost, check how it will affect your discount factor. If you see tax, check tax on your cash profit, check tax on capital allowance, and check the timing. Okay, so we're going to pick a big question to summarize whatever we have said so far. Okay, summarize whatever we've said so far. So I'll read this question. Okay, normally what I do and I explain to students is this. When you have to be solving a question, you don't read that big scenario first. You would have to read the requirement to know what you are expected of doing. This requirement is telling me to calculate NPV, internal rate of return, and discounted payback period. So this question is summarizing those basic techniques, and then we move on to the next level. Okay, so that is the whole idea of preparing the lecture note. We want it to be systematic for you to understand. Okay, but obviously at this level, we can't do NPV alone, internal rate of return alone. That's why we have explained everything and then we bring them to a question. So now, if you are asked to calculate NPV, what do you need? You do not have to be bothered so much about a scenario in front of you. The first thing that you need to remember is, I have to calculate NPV, how is it calculated? PV of the cash flows from return phase minus PV of cash flows from investment phase. And if I have to get the PVs of this and that, I will need number of years, I will need the relevant cash flows, and I will need appropriate discount factor. These are the three things you need for the calculation of NPV. So however big the question is, you have to narrow the question by you trying to identify these three things. Anything in the scenario which is not going to help you to get these three elements, it means that bit of that scenario is not meant to be calculating NPV. It might be meant for other aspects of the requirement, because you know some of the questions, A will tell you to do this, B will tell you to do that, C will tell you to do that, and of course it is all in the scenario. How will you be able to know that this bit of the scenario relates to this question? And that is what I am trying to resolve that problem here, because P4, if you look at the question and it's big, students struggle to know which aspect do I need from the scenario to answer which aspect of the requirement. The solution to it is, what are you supposed to do and how is it done? I'm supposed to calculate NPV. To calculate NPV, I need number of years, I need relevant cash flows, and I need the appropriate discount factor. Okay, so these are the three things I'm looking for. When I go to the question, we would have to pick them straightforward. So I'm going to read and we indicate all the variables we need, all these three variables. So we start. Jetaco is considering a project whether or not to commercialize an innovative muscular toning device, MTD, that will be used in the treatment of sporting injuries. It is expected that the commercial life of the MTD will be 4 years. So I know that project life is 4 years. This is what I've picked. After which technological advances will bring more sophisticated devices to the market, and the sales of MTD will fall to virtually zero. 8 million has been spent in developing and testing the device over the past year. Has something come up? Yes. 8 million has been spent. It's a past cost. So that is a sunk cost, which is irrelevant. So I will cancel it. I don't need it. Initial market research has been conducted at a cost of 2.5 million and is due to be paid shortly. This is also irrelevant because it is a committed cost. The work has already been done. You can't say, oh, because they've done the work of 2.5 and we are not going on to do the project, we are not going to pay the market research company, which did the research. It can't happen. Whether you do this project or not, you still have to pay it. That cost is committed. Okay, so that one too is irrelevant. I don't bother myself with it again. Information on future returns from the investment has been forecast to be as follows. Year 1 up till year 4. Okay, unit demand, selling price in current price terms, variable cost in current price terms, fixed cost in current price terms. Selling price inflation and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed cost represents incremental fixed production overheads, which are wholly attributable to the project. The production equipment for the new device will cost 120 million, and an additional initial investment of 20 million will be needed for working capital. The equipment is expected to be sold at the end of 4 years for 10 million when the production and sales cease. The average general level of inflation is expected to be 3% per year, and working capital will experience inflation of this level. Capital allowances, tax allowable depreciation on a 25% reducing balance basis could be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance will be claimed in the 4th year of operation. Jataco has a real cost of capital of 7.8%. Okay, so this is the question. I have to get a number of years. I have to get a relevant cash flows. I have to get the appropriate cost of capital. MPV calculation is a template. So if I have to calculate my MPV, this is where I am going to start. I will say I need a number of years. The number of years here, year 0, year 1, year 2, year 3, year 4. I leave space in case something should go to year 5. For the purpose of tax, you would have to start with your revenue items. For the purpose of tax, you would have to start with your revenue items. So I will say sales. Okay, sales. I know that sales should be equal to selling price multiplied by unit. So if that is the case, I need to leave space here and go and do workings on the sales. And then I will come back. So I'll come and say workings. Okay, you need that organization, workings. My workings 1 is going to be on sales, which is year 1, year 2, year 3, year 4. What is my selling price? My selling price, according to the question, is given here. These are the selling prices, 2,000 up to the 1,500 for the 4-year period. And it's telling us that they are in current price terms, and selling price is subject to inflation of 5%. If they are in current price terms, it means they are in today's terms. So reference is in year 0. Therefore, you have to multiply by 1.05 raised to the power 1, 2, 3, up to 4. So that is what we would have to be doing here. So the prices given are, the sales prices given are 2,000, 2,200, 1,600, and then 1,500. We would have to inflate it because it is 1.5% and then it is reference to year 0, I have to get 1.051, 1.052, 1.053, 1.054. And what will be the inflated selling price? You will get 2,100 here, 24.26, 18.52, 1823. Then I will need my unit. What are the units? Keeping everything in thousands. If we come up here, they've given us units of 20,000, 70,000, 125, and 20,000. So we pick the unit, 23 zeros up, 70, 125, and then 20. And then I need to multiply. When I multiply the two, it should give me my sales values. It should give me my sales values. And the sales values will be 42,000, 169,820, 231,500, 36,460. And these are the sales values. You move yourself up quickly. You see, investment appraisal questions are always demanding, so I will encourage you to be moving quickly. So I will say 42,000 here, 169,820, 231,500, and then 36,460. I have to get the variable cost. What is the question saying about variable cost? You have the answer in front of you, is in your note. So flow with me so that you know how I'm calculating the figures instead of you trying to copy at the same time. So if you flow with me, you see how I'm calculating each figure. Variable cost is also in current price terms, so we can follow the same principle as we did for sales. So I go down there. Quickly, and I will say workings 2 is on variable cost. Year 1, year 2, year 3, year 4. What will be the variable cost per unit? Question gave to us as 900, 1,000, 1020, and then 1020. We also have to inflate the variable cost. What is the question saying about inflation and variable cost? Question is saying inflation is 4%. So if it is 4%, we're going to have 1.041, 1.042, 1.043, 1.044. And then when we multiply, we're going to get 936, 1082, 1147, 1193. And what will be the unit? What will be the unit? Units are given as, 20, 70, 125, and then 20. If you multiply, you get a total variable cost of 18,720, 75,740, 143,375, 23,860. Then we move ourselves quickly up there. Okay, you have to be on the run so far as investment appraisal questions are concerned. They demand time. So variable cost 18, 720, 75, 740, 143, 375, 23, 860. Then you ask yourself, fixed cost. When you get to fixed cost, you would have to pause, because fixed cost, we said there are 2 times. That's why we explain all those things before we come here. But I'm just using it to hammer it. When you get to fixed cost, you need to pause and ask the question a question. What sort of fixed cost have you got? Have you got a specific fixed cost, or have you got a general fixed cost? Don't assume. Check it. Variable cost sales, they are relevant. But when you come to fixed cost, it could be relevant, it could also be irrelevant, dependent on whether it is specific or it is general. So let's see what the question said. Question is telling us here that the fixed cost is incremental fixed production overheads, which are wholly attributable to the project. And that is what is telling me that this fixed cost will be incurred as specific to this particular project because it's directly attributable to it. And therefore, this fixed cost is going to be what? Relevant. Each year, the fixed cost is giving us 10 million. Do I have to waste time and do the calculation as we did in the note we were teaching? I wouldn't do that. Because it is constant cash flow, I'm factorizing it out. Fixed cost, they said, is subject to inflation of 5%. Point of attention. Okay? Point of attention. Some of you have made up your mind that, oh, fixed cost is fixed. It doesn't change. That's not the case. Fixed cost, it doesn't change with output. But fixed cost can increase with inflation. So watch out. Fixed cost will increase with inflation. Your salaries increase with inflation even though output hasn't changed. So fixed cost can increase with inflation. So when the examiner tell you fixed cost is subject to inflation, make sure you increase it. So though we did the workings in your note, in the examination room, you wouldn't have the time to do what we did there. Okay, you would have to make sure you flow. Because these figures are the same at 10,000, because we did 3 zeros up, this is million. I can pick my calculator, which if you have yours, you can flow with me. I will pick my calculator and say, that specific fixed cost of 10 million being in current price terms is subject to inflation of 5%. So I'll say 10,000 times 1.05 equals, and that gives me the 10,500. I multiply by 1.05 again, it gives me 11,025. I press the equal sign, it gives me 11576. Press the equal sign again, 12155. You've done it. You don't need to go and show any workings. So remember, these are costs. These are costs. So if there's no any other cost, I sum them up. When I sum them up, it gives me what is called the cash profit. Okay? So when you sum them up, it's giving you 12780, 83055, 76549, and then 445. This is what is technically called cash profit. The moment you see cash profit, something should happen. Because when we were doing the introductory bit to calculation of these, we did tax. And we said, where there is tax, you have to respect in 3 areas. First, your tax on your cash profit, your tax savings on capital allowance, and you have to look at the timing. So that is the application of what we were explaining. So the moment my cash profit comes up, I would have to go and look for tax. So when you go to the question, what is the tax rate and when is tax paid? Because we have to respect the timing. So question told us tax, profit tax is at the rate of 30% payable 1 year in arrears. Therefore, we're going to say 30% of that. Because it's 1 year in arrears, year 1 should go to year 2. So when we apply 30% of the 12,780, it's giving us 3,834 bracket. 30% of the 83,055 will give you the 24,917. 30% of the 76,549 will give you 22,965. And this is the time I will create my year 5, and 30% of the 445 should give you 134 minus. The moment you finish this, then you haven't finished completely with tax, because we also have to sort out tax savings on capital allowance. We also have to sort out tax savings on capital allowance. Okay, so now let's see the tax saved on capital allowance. Okay, so let's go down there. We go and do workings on tax savings on capital allowance quickly. So I will say my workings 3 is the tax saved on capital allowance. Okay, now I know there are so many ways you use to calculate capital allowance when it is reducing balance method. P4, as you know, questions are big and you have to work quickly. So we have to cut corners to balance time. So I'm just going straight to do the shortcut thing for you. I wouldn't encourage you ever to use that primary school reducing balance. It will take out all your time. Now, let's go to the capital allowance and see what is happening. Capital allowances at this level, capital allowances are on 25% reducing balance. So if it's 25% reducing balance, how do we calculate that tax savings on capital allowance? Bear with me. Now, when it is capital allowance, let me bring your mind on a basic thing that students sometimes do. Capital allowance is the taxman form of depreciation. And capital allowance has nothing to do with your working capital, because working capital is current asset minus current liabilities. So there is no way you would have to get any capital allowance on your working capital, please. The working capital has got nothing to do with capital allowance. Capital allowance, just like depreciation, should be based on non-current asset. So even though this project will cost equipment of 120 and there is working capital of 20, no way we have to think about working capital when we're dealing with capital allowances. How do you depreciate receivables and inventory? Doesn't happen. So please watch out, because some of you still at this level, some are still including the working capital as part of the calculation of capital allowance. It shouldn't happen that way. Okay, so year one, I will say the cost of it is 120,000 multiplied by the reducing balance rate is 25%. Tax savings is the tax percentage multiplied by the capital allowance. So when I multiply the 120 by the 25%, it ought to give me the capital allowance before I will multiply the tax rate with. Why will I show them 1-1? At the end of the day, I don't need the capital allowance. I need the tax savings. So why wouldn't I go straight? So this times that will give me the capital allowance. So if I've got the capital allowance, I will multiply by the tax rate straight, and I will get the tax savings. And that tax savings is that 9,000. Okay, now be with me. I know at that primary school level, you would have done the cost minus the capital allowance. You get the written down value. You apply the 25% again. You get the capital allowance and you multiply by 30%. It's all waste of time. The common sense here is, if mathematically something is reducing by 25%, where will it reduce to? This figure here, the tax rate here, is going to be constant throughout. So what should be reducing is the 25%. So next year, it should reduce to 75%. So if I'm able to get a 75% here, I will multiply by that 30%. Okay? Yes, you can still watch it because it's being recorded. You can still watch it. Okay? So if I'm able to get a 75% here and I multiply by the 30%, I should be able to get that. The common sense is, if something is reducing by 25%, it should reduce to 75%. Therefore, my year 2 figure will be the 9,000 I got for year 1. That should reduce by 25%, and as such, it should reduce to 75%. So that 9,000 times 0.75 will give you 6750. Then year 3 to 6750 will also reduce by 25% to 75%. Okay? And that will give you 5063. The project is for 4 years. Now be with me. The project is for 4 years. When you sell the asset at the end of the project life, you get what is called balancing allowance if you sold it at a loss. Or you get a balancing charge if you sold it at a profit, if you can remember your F6. Okay? What we are doing, the technique that we are using here, you wouldn't even have to bother yourself whether there was a balancing allowance or there was a balancing charge. Okay, whether there's a balancing allowance or there's a balancing charge, automatically all of them comes together. Therefore, we are going to say something here, so be with me. As your F6 told you, your taxman will give you capital allowance on when you have incurred what is called a qualifying expenditure. And that qualifying expenditure is what you will get the total capital allowance on. And how do we calculate it here? You bought an asset at 120,000. At the end of the asset life, there was a residual value of 10 million here. It means you will sell the asset at the end of its life for 10,000. Did you incur 120? You didn't incur 120. You incurred 110. So the tax man will give you allowance over the life of the asset total of 110. He won't give you 120 because he will tell you you have recovered 10,000 out of the sales. So your qualifying expenditure here will be the 110. So the total benefit you get on the asset or tax benefit you get on the asset is that 30% of the total capital. Okay? Okay, so I will say 30% of this is 33,000. If it is 33,000, now be with me. The whole life of the asset, you are entitled to get a 33,000. But year 1, you claim this. Year 2, you claim that. Year 3, you claim that. How much should you claim at the end of year 4? It should be the difference. So that is why here we say the difference. And the difference here is what you are getting as 12188 sort of. Okay, so this is what I will expect you to be using. This is what I will expect you to be using in the examination room rather than going to use that primary school thing. Even if you are very familiar with this, you can just use the calculator and then you flow. You see, I am pushing you because that is the gap between F9 and P4. P4, you have to be flowing. Okay, so now let's go up there. And then we do the tax savings on the capital allowance. Okay, so dash is here. The tax savings on the capital allowance, this is 9,000. The next one is 6750, 50, 63, 12188. 121. You have to show workings in the exam if it's necessarily. Okay, but if it's not necessarily, there's no need. For instance, this fixed cost. Why should I waste time to go and do workings on this? It's not necessary. Okay, it's not. Okay, so you have to show when it's necessary, like sales. Even though nobody is going to be so much keen about the workings, automatically you cannot do it straightforward because you would have to do the selling price inflation before you can come and multiply. So those aspects that you can flow with your calculator, I would advise you to flow with the calculator instead of trying to show everything. Okay, now the moment you finish your capital allowance, you would have to think about your capital items, which will be the initial investment. In year 0 is 120,000. There is residual value at the end of the life of the asset, 4 years. Don't go and put it in year 5 because the asset will be sold at the end of year 4. Okay. Okay, next. The next one is there any working capital? Is there any working capital? Okay, question says there is working capital. When there is a working capital, you have to pause and ask yourself, working capital, are you subject to increase? Because working capital is not going to be constant unless the examiner tells you so. Because as activity increases, you would have to put in more money to run the business. So when you pick that working capital, you would have to ask yourself, are you increasing? Are you decreasing? If you see what I'm doing, at any point in time, I know a question I would have to ask because these are the areas the examiner is putting the tricks. So if you are not organized to check those areas, you'll be doing, you get to a level before you realize that you should have made that adjustment. So you check, you flow. You check, you flow. You check, you flow. Okay, so when you get to working capital, ask, are you supposed to increase? Question is telling us working capital is increasing by 3%. If working capital is increasing by 3%, let's go and do the workings on the working capital. Okay. So I would say, is it workings 4? I think so. On working capital, year 0, year 1, year 2, year 3, year 4. Okay. So what is the total working capital. Initially, they're telling us that working capital we have to put in is 20,000. That working capital is subject to inflation of 3%. So 20,000 times 1.03 is giving me 2,600 times 1.03, 21,218. Press your equal sign, 21854. Don't go to year 4. Why? The common sense and working capital here is this. This year 0 is not a year. Year 0 is just now. So if year 0 is just now, I put in the money here for the next 12 months. You can use your age. The day you are born, you are 0. It will take you 12 months for you to be 1 year. It will take you another 12 months for you to be 2 years. So it's the same as project. Project is born here. It took 12 months for the project to be 1 year, another 12, another 12, another 12. And working capital will not be put at the end of the year. Working capital is supposed to be put at the beginning of the year. So if working capital is supposed to be put at the beginning of the year, I put this 20,000 for this 12-month period, this 2,600 for the next 12 months, like that. So if I'm putting something here, then it means I'm taking it to year 4 to year 5, okay? Even though some schools of thought actually bring some here. So if you see some of the solutions and they have brought them there and you don't bring, you are not wrong. You are actually right because they are making a different assumption. In the examination room, you haven't got the time, so why will I have to push myself to year 5? Leave it, okay? But truly, the common sense here is that you don't need to put any working capital at the end of year 4. Because if you put it at the end of year 4, it's taking you to year 5. The project is dead at the end of year 4. However, we needed cash flows, and cash flows are incremental for it to be relevant. So what will be the working capital cash flows? This is 20,000. I put in 20,000. It increased to 20,600. It means there is 600 difference. And then it increased again. Okay, when working capital increase, it is what? A cash outflow. When it decrease, it becomes what? A cash inflow. So 600, this is 618 increase, 637 increase, and then be with me. From here, year 3 to year 4, it's moved from the 21,854 to 0. Therefore, you would have to recover it. It's like inflow had come in. So this is how you would have to get your working capital. So let's go up there and then we do the working capital thing. Okay, so working capital is 20,000 here. Okay, this is 600 and then this is 618. Next one is 637 and we recoup 21,855. Sum everything up. It's a template. So when you are asked to calculate NPV and I need my relevant cash flows, I have to picture. I need sales, I need variable costs, I need specific fixed costs. I sort my tax savings on capital allowance, initial investment, residual value, working capital. Any of them which is there, put there. Any which is not there, you skip. Then I come and get my net cash flows. Okay, and the net cash flows here are the 114 and then 12180, 87,603, 57,745, 14398, 12054. Okay, when you get this net cash flow, your next question is, I need a discount factor. What discount factor will you need? You need appropriate discount factor. Remember, you need appropriate. You don't take discount factors anyhow. Okay, we will see it until we finish the P4 syllables. Everywhere you need a discount factor, that question should come up. The discount factor you would have to pick should be consistent. You have to compare like against like. Should always be consistent with the cash flows. These cash flows are after inflation because we inflated the sales, the variable cost, and the other costs in there. So they are after inflation, they are after tax. Therefore, question, I need nominal after tax discount factor. If the examiner had given me anything otherwise, then he's expecting me to do the calculations to bring myself to that level. So this is the principle you would have to be moving with. You have to be interacting with the question. You don't just look at the question and you flow. You have to be interacting. You need to ask for answers from the question. Okay, so when I go to the question, I'm going to ask, where is your nominal after tax? Question gave me real cost of capital of 7.8. Question didn't say whether it is after tax or before tax. But when you were calculating your WACC, if you remember from F9, that WACC you will get is always after tax. So when they say cost of capital without being saying that it is after tax or before tax, the assumption is that it's after tax. Here, they said it's real. Being it real, I cannot use it to discount. I have to convert from real to what? Nominal. So you need to remember the Fisher equation. And Fisher says 1 plus the money rate should be equals to 1 plus the real rate. And the real rate is 7.8. So I have 1.078 multiplied by what is the inflation rate? What inflation rate should you use here? They've given us selling price inflation, variable cost inflation, fixed cost inflation. Okay, they've given us general inflation of 3%. The inflation rate that you need should always be the general inflation rate for the conversion of real to nominal or nominal to real. So I would have to pick what? The 3%, 1.03. And this is what is given about what? 11%. This is what is given about 11%. And I know at this level, 11%, everybody should be able to calculate that. So I'm picking you back to your lecture note. Okay, it's always the generation of the cash flows. That is the issue here. So you have everything in here. Okay, so when you discount it at that 11%, it should give you, everybody knows how to read 11% from the table. And then you will get MPV of that. As long as the MPV is positive, the project should be financially acceptable. The project should be financially acceptable. How do we calculate the internal rate of return? We all said to calculate the internal rate of return, we need two MPVs and their corresponding rates. Luckily for us, we've used 11%, and that 11% had given us a positive word MPV. So in order to get another MPV, I know you've been told you have to do try and error until you get one positive, one negative. Take it from me now. You don't need one positive, one negative. Any two MPVs you will get, put it in the formula, and then you will get the approximate internal rate of return. It is a straight line. This is how it works. It is a straight line. This is the R, and this is the MPV level. This is 0. So if I use 5% cost of capital and I get the MPV here, this will be my point. If I use, let's say, 10% discount factor and I get MPV negative here, I'm going to join these two lines, and this will be your internal rate of return. Do I need this point here and that point here to get this line? To construct a straight line, you need only 2 points. So I could have got a point here positive. I could get another positive here. When I join, it will touch here. Or I could get one negative, another negative. When I join the line, it should be able to get here. So it's an issue of having two MPVs and having their corresponding rate, irrespective of how the MPVs are, whether they are negative or positive, they will give you the same answer. So don't go and waste time. Some of you, first one, you've got positive. You try again, they say try and error. You try again and you go and get positive again, you cancel. You are just wasting precious time. Move on, move on. As long as you've got two MPVs, it's enough. Because the formula, if you remember the formula, okay, it's telling you L plus NPV of L divided by MPV of L minus MPV of H, all multiplied by H% minus L%. This sign here is what is doing the weighted average for you. This sign there is what is doing the weighted, so it doesn't really matter negative, positive. But if you want to get one positive, one negative, there's a strategy. Because the cost of capital is a cost to you, and the MPV is the total profitability if it's positive. If it's negative, it's the loss. So if I've used a cost of 11% and it's giving me a positive, it means the cost of 11% will give me a profit. If I want a loss, what will I do? Obviously, I have to increase the cost. So that is why here we increase it by 3% to go to 13%. And when we read the 13% from the table and we calculated the MPV, it gave us a negative. What is the internal rate of return? The lower rate is the 11%. Lower rate MPV at 11% is the 956. Then we are filling the formula. Lower rate MPV minus will make it plus the 5240 and multiply by the higher rate minus the lower rate. And of course, this is giving you the 11.31 internal rate of return. As long as the internal rate of return is greater than the cost of capital, we have to accept the project. Where there is a single project, MPV is saying yes, internal rate of return will also say yes. Okay, so if you have understood the mechanism, the internal rate of return is the maximum cost of capital. So any cost of capital which is less than the internal rate of return, the MPV will be positive. Okay, so if you know that mechanism, you cannot calculate internal rate of return and then you get, let's say I got 9% here. I won't accept it because 11% gave me a positive. So automatically, the rate that will bring the MPV to be 0 should be higher. Yes. Okay, MPV and cost of capital are inversely related because cost of capital is cost and MPV is profit, and profit is always inversely related to what? Cost. So that is the case. Now let's go to discounted payback period. Let's go to discounted payback period. Okay, let's go to discounted payback period. Discounted payback period measures the number of years the present value of the future cash flows will be able to recover the initial investment. So we pick the cash flows, which we have all done that. We discount the cash flows at that cost of capital of 11%. We've got a PV. If I'm in the examination room, I am not going to do these two because these two is what we've done there. So I will come and pick the present values because I needed the present value, number of years it will be able to recover the initial investment. Here is a lecture note we are teaching. We have to show you where we got all of them. In the exam room, you are not teaching, you are finding the answer. Move on. So I will pick the present value straight. And when I pick the present values, okay, so this is what I will pick because I've already calculated that. Why will I have to waste the time to do this bit? Okay, how many years am I going to use these present values here to pay off this 140 million? So 140 minus this will give you that. 129 minus that will give you this. And then 4221 from that will give you that. Then you take this one to also out of that, and then it will be left with 6192. And that 6192 is supposed to be paid for by this figure. But the whole of this period, year one there, I made this. When within the year did I make that? You do that primary school proportion. So if that year I made 7148, when, which is the X, will I make 6192? My X, so straightforward, be 6192 divided by 7148. And that is what is giving the 0.87. So to take 4 years or 4.87 years to recover the investment. The question here is, should we accept the project? Internal rate of return will give you answer. MPV will give you answer. Discounted payback of 4.87, you can conclude. As you learn from your F9, you remember that payback period and payback period, discounted payback period, accounting rate of return, all of them are subjective because they would have to be compared with a target that the management will come out with. So if a target is not given to you for discounted payback period, obviously you cannot decide. So here you're going to tell the examiner you cannot use the discounted payback period to decide because a target is not actually given to you. Okay, so this is basically the sum of whatever I was trying to explain in the note to you. So use this to summarize everything. So go through the note and then solve the question again because this sums up everything of what we were explaining. Now let's graduate to the next level. When to claim capital allowance. When to claim capital allowance. So far, so good in your F9 or your financial management life. You have been claiming capital allowance year 1, year 2, year 3, year 4, year 5, up to the number of years the project will run. Okay, as we did like this one. Okay, here we started from year 1, year 2, year 3, year 4, like that. Okay, from now onwards, once again, I'm going to bring a condition. From now onwards, so far as your P4 is concerned, when you are about to claim tax savings on capital allowance, you would have to ask the question, when should I claim it? Just as I told you, when you see inflation, how inflation will affect my revenue, will affect my cost, will affect my discount factor. If you see tax, how will tax affect my cash profit, tax savings on capital allowance, and the timing? If you see working capital, are you constant? Or working capital, are you subject to growth? Okay? If you are coming to calculate the tax savings on capital allowance, don't assume straightforward is from year 1, as we did here. Okay? That is what we've been doing from F9 up to this point. From now onwards, when you read the question, ask the question, when do you want me to claim capital allowance? Do you want me to claim from year 1 or do you want me to claim from year 0? This is what your syllables want. So your capital allowance can be claimed from year 1 or year 0. Year 1 means that you do year 1 assuming the project is for 4 years. Year 1, year 2, year 3, year 4, full stop. If it is year 0 you are claiming from, you claim year 0, year 1, year 2, year 3. In other words, the examiner will say capital allowance is supposed to be claimed in arrears, or is supposed to be claimed in what? Advance. Okay, so when he tells you working capital is supposed to be claimed in arrears, year 1. In advance, year 0. In other words, the examiner will give you accounting date. Okay, so you will claim the capital allowance in arrears when the asset is bought at beginning of accounting year. You will claim in advance when the asset is bought at end of accounting year, because we are interested in when the capital allowance will go for the calculation of profit. Okay, so let's go and take figures to illustrate. If you come to your note, we've explained that one here for you. So when the asset is bought at the beginning of the accounting year, or the project is being done at the beginning of accounting year, it will take you 1 year for an account to be prepared. And it means capital allowance will go to the calculation of the taxable profit in a year's time. But if the project is undertaken now, the same time the project is being undertaken, account is being prepared, then in the project life, the life of the project is 0. But that time we are preparing account. The taxman doesn't know accrual concept. He will allow you to claim the capital allowance instantly. So you are claiming the capital allowance in year 0. Okay, let's take these questions to illustrate. AAPLC buys a fixed asset for $10,000 at the beginning of an accounting period, 1st January, to undertake a 2-year project. So these days, when you are reading the question, you have to be a bit tactical than at the F9 level. That is the difference, because P4, they push you closer to reality than F9. Okay, so we are doing the project at the beginning of an accounting period, 1st January, meaning is that account will be prepared at 31st December. So it will take me 1 year from the time the asset was bought to the time the account will be prepared. Therefore, capital allowance will go to that particular account in a year's time. So we have to start claiming from year 1. Okay, net trading revenues at T1, T2 are $5,000 per annum. The company sells the fixed asset on the last day of the second year for $6,000. Corporation tax is 33%. Written down allowance is 25%. We are not going to use this primary school thing again, I told you, okay, because we have to use the 75% rule. It's faster. Okay, now the project is for 2 years. So year 0, year 1, year 2. Forget about year 3 for now. The question told us net trading revenue is 5,000, 5,000, 5,000. Net trading revenue is the same as the cash profit. If you get a cash profit, apply your tax rate. Tax is 33%. They assume that tax is paid 1 year in arrears, so they put a tax of 33% on. The asset is for 10,000. Residual value is what? 6,000. What I'm interested is the capital allowance. When should you claim the capital allowance? Because we started the project at the beginning of the accounting year, capital allowance should be claimed from year 1. So let's calculate the capital allowance. Okay? Because we bought it at the beginning of the accounting period, we would have to start from year 1. So what are we going to get? So I'll say my tax savings on capital allowance will be year 1. The cost of the asset is 10,000 multiplied by residual value, reducing balance of 25% multiplied by the tax rate of 33%. And that will give you, I'm using the shortcut approach. So 10,000 times 0.25 times 0.33 is giving 825. Because the asset is for 2 years, year 2 should be the difference. The last year should always be the difference because of the balancing charge and balancing allowance. So go and calculate your qualifying expenditure. Your qualifying expenditure here is that the asset is for 10,000 minus the residual value of the 6,000. It means you technically incurred what? 4,000. And the benefit you get totally is 33,000. 33%. So 4,000 times 0.33 is it giving you 1,320? And if you have claimed this in year 1, then the remainder should be claimed in year 2. So that from 1,825, and that is 495. So that is what they did in your note for you. But as I said, I haven't got time to do all this long one. Obviously, too, you are not going to get for 2 years. It's issue of 4 years or 5 years. You can't be doing that primary school thing. It's just going to waste your time. Okay, so that is what they did here for you. That is what they did here for you. Okay, because we are assuming tax is paid 1 year in arrears. So this is the approach that we've been doing from F9. So when we are claiming from year 1, then the assumption that we were building in there is that we are starting the project at the beginning of the accounting year. What about if we are starting the project at the end of an accounting year? What about that? Okay, what about that? So the whole idea, let's read this one and see. BB PLC buys a fixed asset for 10,000 at the end of the previous accounting period, 31st December. Why using T2 instead of T1? Okay, because the tax was paid 1 year in arrears. That's the assumption that they made there. That's why the tax on the 5,000 for T1 was in the year T2, and tax of T2 went to T3. So if you are assuming tax is paid 1 year in arrears, then the capital allowance should also move the same alongside. So we claim the capital allowance in year 1, the tax effect should go to year 2. Okay, so that is the reason. Right? But it doesn't necessarily mean wherever the profit tax will go, the capital allowance will go. We're going to illustrate it in the second situation. Okay? Because we are assuming that tax is paid 1 year in arrears, just as we did in the big question that we have just solved. So if you come here, the same way, you see, because tax is paid 1 year in arrears, and you claim here. Yes, the question didn't say anything. The question didn't say anything. That's why I said they were assuming. So if the question didn't say anything, you can also assume that you can claim it tax in year 1 or relevant years. In that case, the tax on the cash profit here, where is it? In that case, you couldn't have put these figures to in T1 and T2 and T3. You have to push it to T1 and T2 on the assumption that you are claiming in relevant years. Question didn't say anything, so you can take your stand. Okay. Next. BB PLC buys a fixed asset for 10,000 at the end of the previous accounting period to undertake a 2-year project. Net trading revenue T1, T2 are 5,000. We're following the same thing. The fixed asset has 0 scrap value when it is disposed of at the end of year 2. Corporation tax 33%. And then written down allowance is actually 25%. Let's calculate the net cash flows. Obviously, I'm not so much concerned about the trading, net trading revenue and the tax on it. The asset is also 10,000. What I am interested is the tax savings on capital allowance. And now be with me here. The asset or the project was actually started in previous accounting year end. So as long as it started in previous accounting year end or it started at the end of an accounting year, that same day the project is being undertaken, an account is being prepared. Taxman doesn't know accrual concept. Accountant will say, oh, we haven't used the asset, we'll use it next year. Therefore, first depreciation will go to next year's account. No, the taxman will give you the capital allowance now. That is one of the reasons why your accounting profit will be different from your taxable profit. Therefore, you would have to make sure that you would have to charge the first capital allowance in year 0. First capital allowance in year 0. Okay, so let's see how it's going to work. This is slightly difficult than the ones that we've been doing when we are claiming from year 1. It's slightly difficult because of what I'm going to actually explain. Okay, now, because we started the project at the end of an accounting year, we're claiming the capital allowance from year 0. Project is for 2 years, remember? So year 1 and then year 2. Be with me here. So the capital allowance we have to claim in year 1 is what we are claiming in year 0. The capital allowance we have to claim in year 2 is what we are claiming in year 1. It's like advance. We are claiming it in advance. Therefore, the cost of the asset is 10,000 at that 25% at the tax rate of 33%. And what are we going to get? 10,000 times 0.25 times 0.33 is giving the 825. Now be with me. Even though the asset is for 2 years and then we are carrying forward the capital allowance, we cannot carry forward the balancing charge or the balancing allowance. The balancing charge and the balancing allowance only comes in if and only if the asset is sold. The first one that we did, we made an assumption. Where is it? We made an assumption that we are claiming from year 1. So if we are claiming year 1 and year 2, here, both balancing allowance and balancing charge is included because we will get capital allowance in year 2 and the asset will also be sold at the end of year 2. So all of them will occur in year 2. But when we come to what we are doing, be with me, this is where this problem is. When we come to here where we are claiming the capital allowance in year 0, year 1 capital allowance goes to year 0, year 2 capital allowance goes to year 0, but you cannot sell the asset in advance. So I cannot sell the asset in year 1 because I need to use the asset for 2 years. And the profit or loss on the sale of the asset will occur at the end of year 2 or will occur when the asset is sold. So you cannot include the balancing allowance or balancing charge in year 1. The only thing you can move it forward is the capital allowance we are claiming. So straightforward, I can say 825 multiplied by the 75% because this is reducing by 25%. It should reduce to 75%. So 825 times 0.75 will give you 618. Okay? Now, when you come to year 2, you don't claim any capital allowance. The only thing you can claim is balancing allowance or balancing charge because that is the time the asset will be sold. So you can say difference. The whole asset was 10,000. Question told you no residual value, so 10,000 multiplied by the 33%, which is 3,300. And you had already claimed this in year 1, this year 0 and year 1. So how much is left? Okay, 0.75 times 825. Oh, this is actually 9 anyway. So we will say 825 plus 619 from the 3300 should give you 1856. So that is what they did in your note for you. But be with me here. I'm going to illustrate something. Okay, be with me here. The capital allowance was claimed in advance. So the capital allowance was claimed in year 0, but tax is paid 1 year in arrears. That's why the tax savings on the capital allowance is coming from or coming to T1. So indirectly, if your tax is okay, you will see that the capital allowance tax savings, we are not charging it against the profit from the project. We are charging it against other profit. Because the day the project started, the project hasn't given us any profit. But we are claiming capital allowance to be taken out of our income statement. So it's being charged against other profit. Because that same day, we haven't made any profit. So watch out. See, when I'm teaching, I always want to bring areas that the examiner can trap you. Because he knows that most of you, capital allowance, year 1, you start calculating, you don't even think of it. So my intention, claim capital allowance in advance, you don't check it. If you go to the examination room, examiner don't take any stand. Examiner don't take any stand how you should claim capital allowance. Okay? Our advice, claim it from year 1 because you are familiar with it. And that one is easier. When you decide to go and claim it from year 0, then you have to be very careful for you to distinguish between the balancing charge thing here and the capital allowance you have to claim before the closing of the year of the life of the asset. So watch out. It's because of the separation between the capital allowance and the balancing charge or balancing allowance. That is the reason why when you are starting claiming from year 0, it's a bit tricky. Okay, so that is the capital allowance. Anytime you are about to come out with capital allowance, watch out and ask that question. Okay, MPV and internal rate of return compared. We are now going to lead ourselves to modified internal rate of return. MPV says accept the project when the project's MPV is positive. Internal rate of return says accept the project when the internal rate of return is greater than cost of capital. So that internal rate of return is the rate making the MPV equals to what? 0. Therefore, what is the position? If MPV is positive, it means automatically the cost of capital is less than internal rate of return. So where I have got only one project, if MPV is positive, automatically internal rate of return will be greater than that cost of capital. Therefore, if MPV says accept the project, internal rate of return will also say accept the project. There wouldn't be any conflict. So when there is a single project, no conflict between MPV and internal rate of return. However, where there are mutually exclusive projects, when do we say projects are mutually exclusive? Projects are mutually exclusive if you cannot do all of them at the same time. If I say project A here, A and B are mutually exclusive, it means I can either do A or I can do B. I can't do all of them at the same time. When you have got these mutually exclusive projects, it is likely that MPV might say choose A, and internal rate of return might say choose B. There might be that conflict. When that conflict occurs, how will you resolve it? When that conflict occurs, how will you resolve? And which of the project are you supposed to undertake? This is what we're going to flow with. Okay? So where there are mutually exclusive projects, there might be a conflict between MPV and internal rate of return. Which one will you choose? Let's assume here that our cost of capital is, say, 12%. When I pick project A, MPV is positive, internal rate of return is greater than cost of capital. Both will say A is good for it to be undertaken. If we look at B, MPV is positive, internal rate of return is greater than the cost of capital. Both MPV and internal rate of return will conclude that B is also good. As long as you are dealing with individual projects, they shouldn't give you any conflict. Now, if we have to choose, because they are mutually exclusive projects, we have to choose one, MPV will tell you choose B because it's giving you the highest MPV. Internal rate of return will tell you choose A because it's giving you the highest internal rate of return. Which one will you choose? This is how the examiner will test you. Okay? So you will choose the one that will give you the highest MPV. Somebody will ask why. Our assumed objective is to maximize the shareholders' wealth. And shareholders' wealth maximization is increasing the value of the company. Therefore, if I have to undertake project A, I will increase the shareholders' wealth by 8 MPV of 610. If I do project B, I will increase shareholders' wealth of 1026. It's a common sense. You forget about MPV, whatever. If I put absolute figure 610 here, and I put absolute figure 1026 pounds, and I tell you to close your eyes to even pick one, I don't think anybody will pick the 610. Okay? The internal rate of return is a relative measure. So relatively, it can deceive you because it's relative to the investment. But absolutely, when you do the investment, you are going to get the MPV values. And as such, your wealth will increase by those MPV values. So anytime any of these techniques, investment appraisal techniques, conflict with the MPV, remember, because our objective is to maximize the shareholders' wealth, we would have to choose the project which is giving the highest MPV. Don't think about any other thing. MPV is the boss. MPV is the master, because the master is to maximize the shareholders' wealth. So the reasons why MPV and internal rate of return might give a different answer or conclusion is that MPV is an absolute measure and internal rate of return is a relative measure. The main reason is the reinvestment assumption. Okay, so this is the reinvestment assumption. Let me illustrate for you to understand it here. Okay, we will say that, okay, if there's a project and it's year 0, year 1, year 2, year 3, and I put in 100, year 1 I get 80, year 2 I get whatever, 60, 70, whatever. I'm just creating it for something. Okay? The common sense here is, if you invest 100 and next year you get 80, what do you do with the 80? Do you put the 80, or do companies put the 80 in a safe and they lock it? Or when you invest yourself 100 and next year you get 80, do you put it under your pillow? Companies don't do that. We don't do that. When you get the 80, that 80 will still be reinvested. Companies don't put them in the safe and lock it to the end of year 3 and they say, oh, this project that we did, we've been able to get a total figure of that. No, they would have to reinvest it. MPV is assuming that these cash flows from the project will be reinvested. And when you reinvest it, the return that you will get is equal to the cost of capital. This is MPV assumption. The long way you could have calculated MPV is to reinvest all these monies and then take the time value of money and compare it to the 100. You get the MPV that you would have normally got. So it's telling you, it's implied that Whatever cash flows you get from the project will be reinvested at the cost of capital. Internal rate of return calculation is implying that these cash flows that you get from the project, you have to reinvest it. You have to reinvest it, and you are going to get a return which is equal to the internal rate of return. And we all know that for this project itself to be invested in, our internal rate of return will be greater than the cost of capital. You have invested the money, you've got the return first, which is 80. You are also going to reinvest it again, and you're going to get a return which is more than the cost of you raising money. Okay, it might be possible, but financial management is saying that you are going to be over-optimistic. You are going to be over-optimistic. That is the reason why that conflict will come. And because of this criticism of this internal rate of return, assuming that the cash flows are reinvested at the internal rate of return, which will result into a conflict and NPV. And we've all concluded the NPV will lead to maximization of shareholders' wealth, and as such, it is better than the internal rate of return. We needed a new form of internal rate of return that will give a conclusion or reinvestment assumption the same way the NPV is making the reinvestment assumption. And that new form of internal rate of return, which is assuming that the cash flows from the project will be reinvested at the cost of capital, is what is called the modified internal rate of return. So that is what brings us to the next level. So modified internal rate of return is an internal rate of return. But that internal rate of return, which will make the NPV equals 0, is now making an assumption that the cash flows from the project will be reinvested at the cost of capital, so that the conclusion that you will get, even if there are mutually exclusive projects, the conclusion that you get from the modified internal rate of return will be the same as the conclusion NPV will give you. Because ultimately, we want to maximize the shareholders' wealth. So modified internal rate of return is the rate that will make the NPV equals 0 on the assumption that the cash flows from the project will be reinvested at the cost of capital. And as such, it's making the same assumption as the NPV. And as such, its conclusion will be the same as the NPV will give you. And this is the question the examiner asked last sitting. Last sitting, question number 3, he gave a scenario. Students were supposed to calculate internal rate of return, modified internal rate of return, and he gave a mutually exclusive project, and they were supposed to choose which one should the company undertake. Modified internal rate of return says choose A, internal rate of return says choose B. Which one will you choose? Because he knows that when he does NPV and internal rate of return, we know that NPV is the boss. And most students forget that in modified internal rate of return is making the same assumption as the NPV. Therefore, the modified internal rate of return supersedes the internal rate of return. So you would have to choose the project that is suggested by the modified internal rate of return, because it is consistent with the assumption of NPV, and that selection will ultimately lead to the maximization of the shareholders' wealth. So let's see how to calculate the modified internal rate of return. Okay, let's see how. We've given you the stages. I'm going to use figures to calculate it straightforward. So now let's get the question. Whichever, let me caution you here, that's why I took the time to explain the cash flows, how you'll be able to get the cash flows, because whichever investment appraisal technique you use, being it discounted payback, being it NPV, being it internal rate of return, being it modified internal rate of return, you will need a number of years, you will need the relevant cash flows. So when you get the relevant cash flows, Your next question is, what is the technique? If it's MPV, discount with the appropriate discount factor. If it's internal rate of return, you choose your own two red. So most questions, examiner is not going to give you the cash flows unless you are lucky. Okay, so here we have given you the cash flows on the assumption that we have already shown you how to calculate the net cash flows. Okay, so picture it. Don't expect that, calculate modified internal rate of return. They've given you the cash flows. Examiner can push you from sales, selling price, unit, inflation, variable cost, specific fixed cost, tax savings on capital allowance, working capital, all of them before you come and get the net cash flows, before the modified internal rate of return will flow. So this is the picture. Because some of you just look at this question like this and expect that if it's modified internal rate of return, it should come this way. No, they can push you from sales up to the net cash flows before you calculate the modified internal rate of return. So let's read. Qatar PLC is considering an investment in a project which requires an immediate payment of $15,000 followed by a further investment of $5,400 at the end of the first year. The subsequent return phase net cash inflows are expected to arise at the end of the following years, year 1 up to year 5. Now be with me. Okay, I told you that at P4 level, we wouldn't say MPV is present value of the future cash flows minus the initial investment, because your investment might be there for more than one period. If you look at this, we've got investment in year 0 and we've got investment in year 1. So we have got investment phase of year 0 and year 1. Then we've also got return phase. This is when the cash flows are coming. Okay, so watch out. It's not always year 0 you continue. Okay, so watch out for that. Calculate the modified internal rate of return of this project, assuming a reinvestment rate equal to the company's cost of capital of 8%. To be honest with you, the examiner is not going to give you this bit, telling you, assuming the reinvestment rate is the cost of capital. You ought to know that as long as it's modified internal rate of return, you would have to reinvest the cash flows from the project at the cost of capital, so that is consistent with MPV. So don't expect this bit of the requirement unless you are extremely lucky. He will just come calculate the modified internal rate of return. Some of the questions, he wouldn't even give you the cost of capital. You would have to go and calculate the cost of capital. Okay, this is how I will expect you to be relating the topics to each other. So I know to calculate modified internal rate of return, the cash flows are supposed to be reinvested at the cost of capital. Examiner or question, have you given me net cash flows? If the question hasn't given me net cash flows, it's my responsibility to go and get a net cash flows. When I get a net cash flows, I need the cost of capital. Question, where is the cost of capital? If the cost of capital is not given to you, question is not wrong. No. You have to go back to the question. Maybe the examiner is hiding or expecting you to calculate the cost of capital yourself. You go and calculate it and you bring yourself to that level. You've got your cost of capital, you've got your cash flows, then the modified internal rate of return should follow. How you coordinate is what is the difference. So when you are learning these topics, don't learn them isolation. Learn them and try to interrelate each other, how this one relates here, how that one relates here. So when he forms the question like that, then you will be able to do that. Okay? Which part is most examinable? We will discuss it later, please. Okay, we will discuss that one later, because now I don't want you to start specializing. No. I don't want you to start specializing. I will talk about it at the end of the session. In the sessions, let me put it that way. So now let's calculate the modified internal rate of return. Our time is only 3 minutes left, but let me calculate this, and then next time we will pick it from wherever free cash flows. Even though we should have done free cash flows, fine, I will adjust it for you. Okay, so to calculate the modified internal rate of return, we will have to reinvest all the cash flows. We are calculating internal rate of return on the assumption that the cash flows are supposed to be reinvested at the cost of capital. So first, all the cash flows from the investing phase, you have to find the present value of the cash flows from the investing phase. Okay, so my investing phase cash flows are the 15,000 and the 5,400. I need to discount them using the 8%. So straightforward, I am going to say my PV of investment phase, year 0, and then year 1. Cash flows giving us 15,000 and then 5,400. Discount factor 8%. 8% year 0, obviously 1. 8% year 1, 0.926. What is the PV? 15,000 and then 5,000. Sum it up. The PV of my investment phase is 20,000. When I get the PV of my investment phase, it's like, even though I invested 20,400, taking into consideration the time value of money, it's like my initial investment is 20,000, initial investment happening in year 0. That's why we said it is the PV of the return phase minus PV of the investment phase. So the PV of the investment phase is what you have brought it as the initial investment, because all these figures are brought it in terms of today, present value. So this 20,000 is like my initial investment. Now, the cash flows from the return phase, we are saying they ought to be reinvested at the cost of capital. So now let's go and reinvest it. So reinvestment of return phase cash flows. My return phase cash flows, I've got year 1, year 2, year 3, year 4. It's for 5 years. Let me leave space here, 1 minute. So 1, 2, 3, 4, and 5. This is the years. Then cash flows. Cash flows given 6, 5, 7, 7, 50, 5, 7, 50, 4, 7, 50, and 3, 7, 50. Okay, now bear with me. What we're saying here is that these cash flows from the return phase are supposed to be reinvested at the cost of capital, compound interest. If I would have to reinvest it, I would have to make a return which is equal to the cost of capital. So I will receive the principal and I will also receive the interest or the return on it. How many years can I invest these cash flows? Project is for 5 years. Remember, this cash flow in year 1 will be got at the end of year 1. So when I get it at the end of year 1, I can invest it year 2, year 3, year 4, year 5, which is 4 times. And the cost of capital is 8%. So giving me 6,500, and I'm going to make a return of 8% over a period of 4 years. What will be the total amount I will get at the end of the period? This is what they call the multiplier. Okay, and that multiplier is your 1 plus r raised to the power n, compounding. So first one is 1.08 raised to the power 4. Second one, 1.08 raised to the power 3. 1.082, 1.081, and then 1.080. Any number raised to the power 0 is equals to 1. So the common sense is, when you got the 6,500, you didn't put it under your pillow. You reinvested it over the 4-year period of the asset. When you got the 775 in year 2, you didn't put under your pillow. You reinvested. So when you reinvested all of them, come the end of the 5th year, what is the total cash have you got out of the investment of the 20,000 you made? This is the common sense we're following. So what is the amount? What is the amount? The amount is you multiplying the 2, and this is 8,843,9763 6707 5130 3750. So when you reinvested all the monies, at the end of the project life, you made a total money of 34,193. So the common sense here is, now I invested 20,000. At the end of year 5, when I open my save, the total monies that I've got from the investment and the reinvestment is this. What will be the discount factor that will make this MPV of these cash flows zero? That discount factor that will make that MPV zero when the cash flows are reinvested at the cost of capital is what we are referring to as the modified internal rate of return. When you get modified internal rate of return, it's actually straightforward anyway. So I'm going to use a long way to explain. When I finish, I will give you the shortcut and we'll cancel the long ways out. This is my cash flow. I need a discount factor, PV. I need a discount factor to discount these cash flows such that those cash flows were reinvested at the cost of capital, such that my MPV will be equals to 0, and that is the internal rate of return. Whatever discount factor you put here, so far as you are in year 0, this is 1, so this is 20,000. For this MPV to be equals to 0, the present value here should be equals to 20,000. So what figure, discount factor, should I put here? Such that when I multiply by that, it will give me 20,000. Simply, it should be 20,000 divided by 34,193. And that is what is given about, is given 2123 divided by 34,193. That is given about 0.585. So the meaning is, if you go to your present value table, you drag 5 years on the 5-year level, a figure which is very close to that. It means the discount factor that you put here, which will give you this over 5 years, is the rate that will make the MPV equals to 0, on the assumption that the cash flows from the project are reinvested at the cost of capital. And that is what is called the modified internal rate of return. If you drag it, you see it is between 11% and 12%. I'm not bothering to worry you with this one because you're not going to use that approach. It's really bogus. It's just too long. Even if you go to your note, I'm going to advise you this bit. Don't bother yourself with it. It's just taking your time. You don't need that in the room. We're going to follow simple common sense. The simple common sense here is this. The simple common sense here is this. You invested 20,000 now, and you invested 20,000 now, and after 5 years, you got 34,193. Why that increase? That increase is the return that you made. So what was the average return? That's the internal rate of return. And that is the modified internal rate of return, because this is based on the fact that this figure is reinvested, or the cash flows were reinvested at the cost of capital before you arrive at that. Remember, it is internal rate of return. The only difference is that the normal internal rate of return reinvested at the internal rate of return, and the modified internal rate of return is reinvested at the cost of capital, so that it's consistent with the MPV. Okay? Why it put in notes then? Okay, don't worry. The reason why we put it in the note is that we are showing you different ways. That's why I keep telling you, note is teaching you to understand so many things. But when you go to the exams, we want to be managing time. Okay, so it's not everything that we've done in the note. You see, we've given you so many alternatives. Okay? So if it is 20,000, and then you were able to get 34,193 after, it means your investment has grown to that. And that growth is what is called your return. And everybody knows how to calculate growth rate. G is equals to your D0 dn 1 over n minus 1. So that is the easiest way, instead of you going to calculate or whatever we did up there. That's why I was telling you, don't bother yourself to use that approach, because it will waste your time. Okay, so we will say that I've got 34,193 out of the 20,000, and over a period of 5 years minus 1, and this one will give you 11.3 exactly. Okay, so I'm not saying that it is a wrong principle. It is a good principle, but I'm putting you directly into the examination room, and as such, I don't want you to use this long approach. The moment you get this, put it in the growth formula, and then you will get a modified internal rate of return, because that is why it has grown. Okay, there is a third approach. There is a third approach, and the third approach is formula. And this formula is in the examination room. So what I'm telling you is that first approach I did, don't bother to do that in the room. You can do the second approach. After you've got these two figures, put it in the second approach and go. Okay? The third approach is the formula approach. And according to the formula approach, you would have to bring the formula from the formula sheet. It's saying your modified internal rate of return is equals to the PV of the return phase cash flows divided by PV of the investment phase cash flows, all raised to the power 1 over n, all multiplied by 1 plus r, all minus 1. Okay? When we say PV, it's not the same as the reinvested amount. The reinvested amount we compounded. PV is you discounting. So we have to discount the cash flows of the return phase, which the lecture note did for us. So let me pick you straight. So when you discount the cash flows, we said year 1 is 6.5, year 2 is 7, like that. These were the cash flows. Discounted at the cost of capital, 8%. 8% year 1, 8% year 2, 8%. Everybody knows how to get discount factor. So when you multiply all of them and you sum up the present value, this is the total present value of the return phase. And then we had already calculated the present value of the investment phase. So if the investment phase present value is 20,000 and present value of the cash flows of the future cash flows is 23,271. 23,271 raised the power 1 over 5 multiplied by the cost of capital is 8%, all minus 1. When you solve this, you'll be able to get 11.30%. Okay, so it is issue of your choice, if I have to put it that way, which method you would like to follow. Okay, but I will prefer that you forget about the first one because it is just too long. Okay, our time is up, so I would have to stop here. And then even though we're supposed to do the free cash flows and the duration, I do appreciate this chapter. There are a lot in here to learn. So don't worry, I will balance the time next week for you. Okay, so what I would have to do is, now, we should have done this bit. The only thing you need to know is that for recapping, go back to the calculation of MPV, internal rate of return, modified internal rate of return, leave the duration, and then leave the free cash flows. When we see ourselves next week, we will pick it from there. Any questions so far? Okay. So the only thing here is that if you have got any other question, you can send it through to me through my email at facon@lsbf.org.uk. Okay, so otherwise, I would have to thank you very much for your time, and I'll see you next week. Thank you very much.